One thing we have to keep in mind is when the Bank of Canada hikes interest rate like they have, and prime's gone to 6.45, that doesn't necessarily mean that fixed rates go up to 6.45%. A lot of people don't understand that, but the fixed rates operate off the bond market. And ironically enough, the bond market's actually signaling a recession coming fairly soon. Bond yields have actually dropped and gone back down a little bit on the long end of the curve. We're seeing some of our fixed rates dropping. That's very positive news for somebody wanting to take a 5-year fixed rate. It also signals to us that as much as the Bank of Canada is saying that they're fairly close to being done on this rate hiking cycle, also the bond market, which is trillions of dollars, is also signaling the same thing, that they think a recession is coming, rates are kind of at their top, and fixed rates start to trickle down. After that, prime will likely trickle down as well. And then slowly over the second half of 2023, that's when you're really gonna see them hinting toward a prime decrease, which is good for variable rates. And in that time, fixed rates may come down as well. What I'm hearing from a lot of people on the street, some hedge fund guys, economists, things like that, is over the next 2 years, you are gonna see fixed rates likely land in that 3 to 4.5% level, so lower than they are today. It's hard to imagine. I'm not someone I feel like I'm a realist. I try to look at the full picture and not drink the Kool-Aid of the most optimistic scenario. But at the same point in time, if you look at history on where interest rates are at, you look at where the bond market is signaling today, that anywhere from that 3 to 4.5% range over the next couple of years is my likelihood where fixed rates are gonna land. And that's a positive because it's lower than where interest rates are today. And that's good news for consumers.